Now, for our first conversation, we have Genghis Capital Asset Management's Caleb Mugendi, who has joined us to speak about Kenya's much-needed market resurgence after record lows. Thank you for joining us, Caleb.
Thank you for having me.
Let's start with what we've seen, the recent changes, the stock market going up, Eurobond finally refinanced, and a steady Kenyan shilling, something we did not see much of in the last year. And also now Kenya among the best performing across sub-Saharan Africa, ending 15th March. What has led to this? What changes have happened in the Kenyan market?
Well, we see that the currency has really appreciated year to date. We started the year expecting further declines, and that's what happened. We had a depreciation in the currency towards the start of the year, but then the currency did rebound strongly after we were able to refinance the Eurobond with raising more funds from another Eurobond. And this has led to the Kenya shilling appreciating substantially, close to 13% year to date, with last week's performance around 5.6%. This coupled with the equity market performance last week, where we had an increase in the all-share index of around 7%, led to the Kenya bourse being one of the best performers in Africa last week in terms of dollar return. And what led to the buoyant performance in the equities market is a combination of a number of factors. We do have the banking sector releasing their full year 2023 results, and so far this has been quite positive, with three or so Taiwan banks releasing positive numbers, and also registering or giving out a significant payout in terms of the dividends. So we have Stanbic Bank, where the yield was around 13%, Standard Chartered, where the yield was around 14 to 15%, and now Absa Bank, where the yield is also above 10%. And this has led to investors now positioning themselves to be able to take advantage of this good payout in terms of dividends. We also had Safaricom that closed its books for the interim dividend payment last week, and that's also spurred investors to position themselves in order to be able to capture that dividends. Furthermore, we also have the fact that the shilling has stabilized and also appreciating. This has led a lot of investors to especially foreign investors, to come back onto the buying side in the market, where they're able to look and see that the currency is now stable, is actually even appreciating, and the local interest rates have remained on an upward trajectory during this year. We did have the infrastructure bond that raised close to 240 billion shillings, and this has remained quite it's quite attractive for foreign investors, and it's also been trading a lot of volumes lately. And foreign investors are able to now position themselves and see that because the currency is more or less stable, or has been appreciating year to date, and also the attractive yields in the market, then the risk profile of the country kind of warrants the return profile of the country kind of justifies the risk of coming back to invest in Kenya.
Right, Caleb. Now, those are some positive signals. They should create a more positive market sentiment in Kenya. But at the same time, the previous week, we've seen a fall in fixed income markets. How are the bourses doing? What changes are we seeing there?
Well, for the fixed income market, we do have investors being or preparing to bid for this month's two bonds that are still on auction. We do have a new 10-year bond that has a fixed coupon rate of 16%, and the market is looking at that very keenly to see where the bids will lie, following that signal by the central bank of trying to regulate or stabilize the interest rates at current levels, and not allow them to increase substantially. And we also have another reopened bond. We did have the initial reopened 3-year that was able to raise close to 34 billion shillings against a target of around 40 billion that closed earlier in the month. So investors are now just preparing for these auctions, and we do expect that this will close within the coming week or so. And that could be why the volumes traded in the secondary market took a dip last week. However, even just looking at the performance today, we find that the volumes had a uptick to trade at close to 7 billion shillings, whereas last week's we had around 20 billion shillings traded in the fixed income market. So this uptick this week again still signifies that there's a lot of demand in the secondary market for, especially for the infrastructure bonds that are tax-free and still yielding above 17% in the secondary market.
All right. Also, at the same time, we're seeing some, banks are giving out their earnings. Some of their dividends are looking much, further up. Stocks are performing a little more strongly. How has that, or how do you see that changing investor confidence and interest in Kenyan markets, capital markets, and otherwise money markets now?
Sure. The market is currently still undervalued. If you look at it from a historical price to earnings perspective, we are trading around 5.4 times PE, whereas the historical average is above 7 and 8, and also the dividend yield still remains attractive with a dividend yield of around close to 8.5%, where again the average is below 5%. So there are a lot of pockets of value in the market, and with the release of the banking sector results for last year, investors are able to reposition themselves or realign their forecasts. Given again this year we still expect, or again this year how it has started with the central bank raising the central bank rate to above 13%. This has also increased the base lending rates in the economy, and banks will definitely be able to take advantage of that with higher interest rates on their loans. And this will also lead to them growing the interest income and the net interest income quite faster than in previous years. And we're also looking at the private sector credit growth that remains around 13%, which is still also above its historical average of around 10%. And this still indicates that there's still some lending happening to the real economy. So banks are in a unique position to continue to grow their revenues and also to continue to grow their earnings, given the current environment in Kenya. And investors are able to now, given how the results are being released and how the results are turning out, looking again at the non-performing loans, we've kept this at around 13%.
We did discuss that also this morning. We've seen how banks are making provisions for that. Before I let you go, a very quick comment on what are the drivers currently, do you think, for the bullish sentiment in the equities market? We'll wrap this up right away.
Well, for the equities market, again, we're looking at the purchasing managers index that bounced into positive territory. So we do still expect that there will be economic growth in the country that will at least meet the 5% targets, the historical average. And then we are looking at it from the perspective that a lot of the counters did have sustained sell-offs in the prior years because foreigners were heavily on the sell side. So once that changes and foreigners start to reassess the risk versus the return profile of the country, we do expect there to be a major uptick. And again, there is the local investors who, once upon seeing that foreigners are coming into the market, they're also able to realign their portfolios back to the equities market. And that should lead to some gains.
There's clearly a lot to discuss on that. Last comment, getting stretched here, but thank you so much for joining us, Caleb from Genghis Capital Asset Management.